By the end of market today, Walmart stock will be splitting 3-for-1, meaning if you own one share of Walmart at the end of today, on Monday when the market opens, you will now own 3 of those shares instead of 1. So is Walmart a company we should be adding to? We're going to take a look, see if it's undervalued. We're also going to discuss whether stock splits in general are good, how the historical performances of companies that have done stock splits fared over the last few months after their split. We're also going to talk about Walmart's earnings that they recently came in very, very strong, as well as their dividend, which was increased by 9%. Very nice, especially for Walmart, who don't typically do large dividend increases. And we'll do the typical analysis. We're going to see their historical performance over the last few years. We're going to take a look at the numbers that they produced in their latest annual report for January 2024. And we can compare it to the last few years as well as the bottom line net income. We're going to take a look at their balance sheet, a quick health check, total cash versus total debt. We also want to see how they've performed versus other competitors in the industry, and as a whole, whether the last 5 years this industry is one that has been performing very well. We're going to talk about their dividend safety, which looks to be very safe, dive into some of their financial metrics, some of their free cash flow metrics, their net debt to EBITDA, and we'll talk about some executive president as well as the CEO who have been selling a lot of their shares over the last few weeks. And as always, we'll take a look to the institutions to see whether or not they are still buying shares after this report and whether or not quarter on quarter this is a company they continue to add. And as always, we'll run Walmart through our intrinsic value calculator to get to our acceptable buy price given our investor margin of safety and see what Wall Street are forecasting over the next 12 months based on the earnings report and the stock split. So let's just gather a few more details about the stock split. So we can see here they are preparing for their first stock split in more than 2 decades. And what this means, as we said, a 3-for-1 split, meaning investors will receive an additional 2 shares for each one they own. So if you own 1 share today, on Monday you'll have 3. If you own, say, 10, you'll have 30 on Monday. And what this essentially does will increase their shares outstanding from 2.7 billion to 8.1. And the last time they did this was April 1999 when it split the shares on a 2-for-1 basis. Now again, just to reiterate, this will happen after the market closed today, and we can see it will be beginning on a post-split basis on February 26th, so again on Monday. And what this means, the share price at the end of the market today will be divided by 3, and that will be their stock price going forwards from February 26th. Now, one thing we also just wanted to point out is whether or not stock splits are good and what the data shows, as investors sometimes may get a bit confused as to realistically what the implications are. Now, very briefly, just a few of the key findings. Now, stock splits don't affect the value of shares that you hold in the company. If you hold 1 share now, argument's sake, it's around $170. When the market opens and you have 3 shares, the total value will still be $170. So again, that won't affect the value of the shares you hold, just purely the numbers. Again, we can see here a stock split isn't a reliable indicator of whether or not the stock's value will increase or decrease, and it is often better attributed to the longer term or market trends. In terms of how 5 companies, when they take a look at of a stock split, only Amazon, as we can see, since then outperformed the S&P 500 3 months after the stock split, but it also fell behind over the long term. And we can see Shopify, which was one of those 5, had the worst results with their share price dropping significantly. Although this is the key point that I want to say here, it was due to the continuation of a longer trend. So in conclusion, this is important to know, the value of your shares won't change, just the number of shares that you hold. And in terms of historical data, only one of them realistically outperformed the S&P in the shorter term. But again, this does come down to the individual stocks as well as the longer term and market trends. Another thing I just wanted to point out, just a cool statistic, is that super investors who own Walmart, we have the likes of Bill Gates, who holds around 1.1% of his portfolio, around 516 million, and we have Ray Dalio as well as Joel Greenblatt, who are among some very, very popular super investors. So in terms of their earnings, which came in a few days ago, we can see it came in at $1.80. It did beat analyst estimates of $1.65. On top of that, it was a 5.3% increase from their earnings last year. Their revenue also increased 5.7% to 173 billion, and again topped analyst mark of 170.6. So very, very strong, both top line as well as the earnings per share. And we can see here in terms of their guidance for 2025, they expect revenue to rise single digit 3 to 4% and their sales to grow 4 to 5% adjusted for the earnings per share range of 148 to 156. Another key thing for dividend investors, we can see their annual cash dividend has been raised by 9%, and we'll take a look shortly at those dividend increases, but very, very nice to note. So let's take a look at the numbers, and we can see right now they are up 22% over the last 12 months. Again, this doesn't include those dividends reinvested, and if you were to look over the last 10 years, you would be up 135%. So fairly positive to note. They are currently trading at the 52-week high or thereabouts, with a yield trading 12 months of 1.3% and a forward PE of 25. In terms of insider trading, as always, we like to pull out any insider buys or sells over the last few months. What we've done here is looked at buys and sells, minimum 100 shares, at least the last month, just to be on a more recent trajectory. And we've noted sales by the executive vice president as well as the president and CEO. In fact, we can see 25th of January as well as the 1st of February, so fairly recent. In total, they've sold around 1.7 million worth of shares. And as we always say on the channel, insider buying is a bullish signal. Insiders essentially buy because they believe the share price will go up. Insider selling, on the other hand, isn't necessarily a bearish signal. They may sell for many reasons that we don't know, personal or financial. And we can also note since they sold both occasions, the share price has gone up. So always take that with a pinch of salt. In terms of institutional ownership, well, it sits at 33%, around 11.6 billion worth of sales by the institutions over the last 12 months, 149 billion of buys over the same period. So these institutions are buying a lot more shares than they are selling, with the largest becoming in Q2 of 2023. And we do also note in the more recent period, Q4, 8.25 billion worth versus 2.5 billion sales. So again, institutions do love Walmart. They have been buying this a lot more than they have been selling. But as always, do your own due diligence before jumping into any stock based on what institutions or anyone else says. So let's look at the numbers on the income statement, and what we want to see on total revenue is around 3 to 7% growth year on year and growth over the longer term. 524 billion in fact reported in 2020, and then we can see 2024, so that latest annual report we just ran through, 648 billion. So very nice growth over the last 5 years. And what I also quite like to see here is those granular increases. There are no inconsistencies, so that is very positive for this company. Now, when we take a look at their bottom line, and we will also, when we look at our metrics, look at the percentage increase year on year, we can see the bottom line has increased from 14.9 billion to 15.5 billion. Although on a more granular level, what we see here, a bit more interesting. In fact, we see it decrease to 2021 before increasing and then decreasing and then increasing. So yes, over the longer term, the bottom line is moving in the right direction, but there are a lot of inconsistencies when we look on a more granular level. In terms of the balance sheet, a quick health check, total cash versus total debt. What we see, the cash and short-term investments go from 9.5 billion in 2020 to 9.9 from that report we just went through. So they hold a decent amount of cash, and it has increased, although very slightly, over the last 5 years. When we now look on a total debt basis, what we can see, 73 billion down to 61 billion. So I do quite like to see that when the cash increases and that total debt decreases, it is positive for the business. And we'll look at the net debt to EBITDA metric specifically for this and Dividend Safety. So very quickly then, looking at some competitors, we have Costco, we have Target, Dollar Tree, Dollar General. Over the last year, now in our total return basis, so those dividends reinvested, Walmart is up, as we can see, 25%. So very strong. In my opinion, we do see it only outperformed by Costco, which has had a phenomenal year, up 55%. And when we extend this over the last 5 years, we see a fairly similar performance. Walmart up 94%, very, very strong. And we can see, though, it is outperformed again still by by Costco up 272%, and Target over the last 5 years of 135%. So still a decent performance, 94 with those dividends reinvested, but do remember past performance is never an indicator of future performance. Let's jump into the dividend safety. Now a score of 90, it is very safe. Market cap 472 billion, it is a mega cap company. In terms of those recessionary metrics, well, they increased the dividend during the last recession. They had plus 0.1% recession sales, which is above the average growth of companies in the S&P, coming to around negative 12. And this here, as I always say when we do take a look at Walmart, is probably one of the best recession returns we have ever analyzed on the channel, plus 7%, while the S&P on average had negative 55. In my opinion, Walmart is truly a recession-proof stock, so do bear that in mind into your thesis. Now, dividend growth, I'd love to see this increase 9.2%, and it was what I was trying to say earlier. Over the last 5 years, it has been very poor at 2%, so nice to note that very high single-digit increase. However, over the last 20 years, they have been increasing the dividend by 11%, double digits we love to see. They're also 1 year away from becoming a dividend king, so that will be a very nice status for management and shareholders. In terms of dividend yield theory, now it states the company is undervalued when the current yield sits above the 5-year average. So right now we have it near the 5-year average, although slightly lower. So you could argue based on this theory, slight overvaluation or reasonable valuation. On the forward PE, 25 versus 23.4. Again, you could argue some slight overvaluation or reasonable valuation. And we're not looking at any of these models in isolation, and we'll conclude towards the end. Consumer staples sits at 20, so lower than Walmart's 24.9. As always on the channel, we draw your attention to the right, the free cash flow payout. We do ignore the earnings, which is susceptible to manipulation by management through accounting. What we want to see here, in my personal opinion, below 60% gives us faith that management are able to offer those double-digit dividend increases we love to see. You can go more specific for the industry, below 40% for consumer retails. But overall, very, very strong. In my opinion, below 60% is very positive. 2024, so that is January 2024, because of the way they report for 12 months ended Jan 24, 41%, looking very strong. 2025 is expected to increase to 63%, but still that is something I am happy with, around that 60% mark. Free cash flow per share. Now, this is a little bit inconsistent. We can see minimal movement from the last 10 years, $5 to $5.62. Very, very inconsistent over that period. But as always, it is something just to bear in mind and important to look forward to management's guidance for the next year. Sales growth, as I mentioned, 3 to 7% is what we want to see for steady, moderate growth. At a minimum, 3% or even 4% just to keep up in line with inflation. Nice to note the last few years have been very strong, but overall, this is a company that essentially their top line just increases with inflation. So understand the companies you're looking to invest in. This isn't a tech company that's going to be growing their top line very, very fast. And we can see 486 billion of sales in 2015 to 648. We also see their shares outstanding decreasing year on year, a very positive sign. Share buybacks, 3.24 billion in 2015, 2.7, essentially returning excess cash to investor pockets. Speaking of share buybacks, we have released our latest newsletter completely free discussing share buybacks, looking at a lot of companies that do a massive amount of share buybacks, returning a lot of value to shareholders. If you want to grab a copy of this or any of our other articles that we have written over the last few weeks, completely free, do click on that pinned comment below. ROIC, now this is one of my 7 golden dividend metrics. If you want to see the other 6, it is in fact in one of my weekly articles. I want to see 10% or more to give me faith management are able to effectively allocate their capital. Very, very strong performances year on year. The last 2 years at 16%, very nice to note. No real worries based on this information. Now, operating margin and free cash flow margin, again, for consumer retailers, it is something that we see. They do tend to lack that ideal target that we set of around 10%. We do know, however, the consistency around that 4 to 5%. Whilst it isn't the worst, do bear in mind, if we are to end up in a recession in the US, then you could argue that consumers will be looking for products that are a lot cheaper, and then maybe Walmart may have to drop their margins to entice more customers to come back. Something just to consider. Free cash flow margin, again, lacking very slightly, but we can see on both margins, this is something that has been there consistently. So when we do take a look into it on a deep dive, it may not necessarily be an issue right now. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, this shows us two things, the balance sheet strength as well as the dividend safety. And what we're looking for here is below 3 for consumer retailers. And essentially, what this shows are the number of years it would take the company to pay off all of its debt net of cash on hand. Nice to note, 1.32 in 2024, expected to go lower in Jan 2025. So no worries there based on this information on the balance sheet strength or the dividend safety, which is very safe. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we run through every single one of these models to get to the intrinsic value. For today's episode, let's jump straight into the calculation. And for Walmart today, we see that the intrinsic value is around $194. Don't forget you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment below. Margin of safety then, for those that are new, we typically start off with 10% and we use that if we believe it meets 3 criteria: wide moat, strong financial metrics and good forward-looking data. We can see right now it is pretty much $1 shy, so we do see it at around a 10% margin of safety. And then again, it does depend whether or not you believe that is sufficient. If you are looking for 15%, you'll be looking to buy around 165, at 20% around 155, but at the moment we just see a 10% margin of safety. In terms of Wall Street, over the next 12 months, well, they see upside of 10% with a price target of $193. And what's important to note, if you are watching this episode live on the same day that it is released, these will be the current prices of Walmart. If you watch it from next week onwards, these prices you will have to divide by 3, as remember they are doing a stock split 3-to-1. And just finally, just as a reminder, there will be no extra value by holding these shares. All that happens is for those holding 1 share, you'll be given additional 2 and so on a 3-to-1 basis. If you have any questions about any of that information, do let me know in the comments below and I can explain it clearer if need be. But do let me know your thoughts, whether or not you believe that Walmart is undervalued if you are buying before the stock split, or maybe you're going to wait and see what happens in the market next week on that stock basis ratio. As always, have a great day. If you enjoyed today's episode, smash that like button, and as always, I'll see you on the next one.